Hi, everyone. Thanks so much for joining us. It's 5:30 right now on the East Coast. We're just going to wait a couple more minutes for people to join. But in the meantime, if you are on the Zoom app, you can open up the chat and share your name and where you're from. And Anna, who's our moderator, can read some of them out loud so we can get a sense of who's in the virtual room.
All right, so we have Lauren from Boston. Hi, Lauren. So we have, I hope I'm pronouncing this right, I'm sorry, but Phoebe from Jamaica Plain, Boston. Hello. We have Christina from Toronto. Jen and Kurt from Salem, Massachusetts. We have Hilda from DC. Natalie and Victoria from Ellsworth, New Hampshire. If you're just joining us, feel free to type your name and where you're from, and I'm just going to announce it just so we can get to know everyone who's here in the virtual chat room.
You're also welcome to put on your video. Yep, we're doing it. We're letting everybody show their video. We're trying to recreate, an ambiance of togetherness.
Hi, we have Kate from Cambridge. We have, I believe it's Carwyn from Cardiff, Wales. Judy from East Ham. Claudia and Michael from Philadelphia. Mary
We have
Beth.
someone in transit. That's fun to see.
Yes.
Thanks for joining us while you're walking.
We have Chris from Andover and Colleen from Haddonfield, New Jersey. And if you're joining us on the YouTube live stream, feel free to put your comments in the YouTube live chat as well. You can also send your name and where you're from. We have Marshall from Westchester. My name's Anna. I'm in Lancaster, Pennsylvania.
Dave from San Diego.
Nice. We have Steven from Sacramento.
All right, let's get started.
A couple more people on YouTube. Dennis from Canada. Hey, Dennis. And Mary from Somerville. Hello.
All right, thanks. So I'm going to share my screen here. So thank you, everyone, for joining us. Thank you also for staying home and keeping yourselves and others safe during this turbulent time. My name is Laura Hesse Fisher. I'm the founder and director of Civic Series. We are a volunteer-led nonprofit organization that helps you understand, think for yourself, and have meaningful conversations about the most important issues of our time. Our events, like this one, allow you to ask questions of experts in a nonpartisan and safe space. So the goal of today's event is to help us all understand what an economic recession is, the impacts, who the decision makers are who steer our economy, and what tools they have to stabilize our economy. Before we begin, I'd just like to give a big thank you to our largest donors, the Rhyme and Reason Fund of the Boston Foundation Amy and Dan Harris, Ross and Jane Kepner. And thank you to all of those, including many people on this call who have donated to Civic Series. I invite you also to send us a donation. Even $5 or $10 means something to us. We're a volunteer-led organization, and your donations go very far. You can find us on Venmo or PayPal. Okay, so here's how tonight is going to go. Our guest expert, Dr. Louise Sheiner, and I will give a 30-minute overview of tonight's topic, and then we're going to open it up for your questions. Our in-person events are pretty interactive, and we're going to try to replicate that here. So we invite you to turn your video on, though, as you might have noticed, we have everybody muted. When you have a question for Louise and you're on the Zoom, you can send it to our moderator, Anna, in the Zoom chat box. And then when we get to the Q&A portion, Anna will introduce you and unmute you so that you can ask your own question live. And it'd be great if you could have your video on when you do that. If you're watching on YouTube, or if you prefer, anyway, you can call or text your question to our voicemail box at the number that's right here. And also include your name and where you're from. We'll also be asking questions that you submitted when you registered. So I want to emphasize that there is no such thing as a dumb question. The whole point of Civic Series is to give you the safe space to ask the questions that you think are too dumb to ask anyone else. And I volunteer to be the dumbest one in the virtual room. Okay, great. So I'm really pleased to introduce our guest expert today, Dr. Louise Sheiner. She is the Senior Fellow in Economic Studies and Policy Director in the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institute. Dr. Sheiner, we're so pleased to have you.
Thank you. Glad to be here.
Is there anything else you want to add before we jump in?
No, I think I want to echo your comments, which is I hope everybody is staying home, staying safe. I hope everybody's healthy. And I'm just really glad to have this opportunity to talk to all of you. And also to echo this idea that there's no such thing as a dumb question. Please just feel free to ask your questions. I'll do the best I can to answer them. Sometimes questions you think are dumb are actually really hard to answer because they're not dumb at all. And just that's why you never hear people talking about them. So let's try to keep it informal. And I really look forward to the conversation.
Great. Okay, so let's get started. My question for you first to kick it off is, what exactly is a recession, and how is it different from a depression or a Great Recession?
Okay, so a recession is basically when you have a decline in economic activity. You might think about it sort of when the unemployment rate goes up. So instead of everybody working, people can't find jobs. Or they are not working for other reasons like now. And so that means that sort of the level of economic activity, which you hear mentioned as GDP, gross domestic product, falls. Usually we think for 2 quarters, so 6 months is generally how it's judged, but it doesn't have to be. It's kind of judged after the fact that this was clearly an event where economic activity kind of got bad. And the difference between depression or the Great Recession, these are not technical terms. The Great Recession was really a very bad recession. And so people started referring to it as the Great Recession. I think when people use the word depression, what they really mean is not just something that is sort of very bad, but very bad for a very long time. You're sort of stuck, in this hole, in this depression. It's kind of hard to get out of. But those terms are sort of all a matter of degree.
So there's not really a standard definition for what's the difference between a recession or a depression?
No, there isn't. And in fact, the recession itself, there's not even a definition of a recession. There is something called the National Bureau of Economic Research. They are the official committee that dates recession. So they decide after the fact when the recession started, when it was over, and if there was one. And that's kind of judgmental. They might, they could use this GDP thing, but it doesn't have to be. They could say, look, the unemployment rate was really bad. So it's not, there's no technical, like this is an official definition.
Okay, that's interesting. I just always assumed it was official.
Yeah.
You were talking about economic activity. I mean, clearly, people are not able to go out to restaurants and socialize, and people are buying less. What are we talking about?
That's exactly what we're talking about. When we think about what economic activity is everything that people are buying. It's investment by businesses who are buying equipment. It's spending by governments. It's all those things that pay for all the employment, right? So people pay for employment and they produce goods. So it's all of that stuff. So it's, you might think about it as GDP, which is what the word we use for like economic activity, is trying to measure kind of how much stuff people have, economic well-being in some sense, right? It's not well-being overall. It doesn't talk about things that are not about economics, but from an economic perspective, it's kind of measuring the size of the economy, which is kind of how much everybody has, or on average.
So why should we care about that? Why are like, people are really obsessed with monitoring the economy, making sure it stays healthy?
So I
Why is
think,
that?
yeah, so I think, as I said, I think we think about the economy as kind of as shorthand for how well are people doing, right? So when unemployment goes up, for example, families don't have income, they can't buy what they need to buy. When GDP isn't growing quickly, people, it may not be a recession, but it just means that living standards aren't growing as quickly as, so we sort of think about GDP as a measure of living standards. How well off are people? How much stuff do they have? How are they doing?
We could probably have a whole other Civic Series event that's focused on if GDP is a good indicator of economic well-being.
Absolutely.
But we won't go there
Let's
in
not
this
do
session.
that, but yes, you absolutely could.
So what are the indicators of a recession? How do we know one's coming or one's here?
Right. Well, so today, actually, the official statistic, the first read on the first quarter, January, February, March, came out, and GDP declined almost 5%, right? And that's all stemming from what happened just in March. So we know that we are in a recession, also because we know that it's not coming back sort of anytime soon, right? So that we already know that the second quarter, April, May, June, is going to be even worse. People think it could be something like a decline of 40%. It's huge, right?
Wait, you said 40%?
40 is the number you're here, but
I mean, that's extreme.
yes, but it's not. But let me explain how to think about these numbers. So a decline of 4% is really a decline of 1% for the quarter. And the number that you hear is always what would happen if that happened quarter after quarter after quarter. So 4% would be if 1% this quarter, another one next year, next quarter. So 40% means the actual level of output declines about 10%. So it's like 1% now, another 10%. It's still huge, absolutely huge. And so it's definitely a recession.
So, okay, so I mean, we're talking, so in GDP, that grows by how much percent typically? What's the mark of a good economy?
Well, so it
Percentage growth.
depends. So it depends a little bit on your population growth too, because sort of as you have more people, you expect the GDP to grow more quickly. But let's say, Trump, for example, President Trump has been saying he's going to get 3% GDP growth. That's a good number. We're not going to, that's not what, we probably are getting something closer to 2 before the recession. So like 2% GDP growth means every year you have 2% more stuff. But these declines are the kinds of declines we saw in the Great Depression. They're much larger than any single quarter decline than we saw during the Great Recession. So it's a very, very big, fast drop. But we know what that's from. That's from everybody staying home and not buying stuff and not going out. So it's a little bit different in the sense that it's not like, oh my God, this is so bad because the economy is in such terrible shape that we caused this terrible outcome. It's like, no, we actually decided that to protect public health, we are going to sort of take that economic hit and have people stay home and have people not go to restaurants and not go to concerts. And so it is different. And so we're all trying to think about, how do you think about it, right? It's not something that we've seen before, right? The Great Depression wasn't done on purpose. This one sort of is.
So we're somewhere, the economic drop is somewhere in between the Depression earlier in the century and the Great Recession that we experienced just about 10 years ago or so. You mentioned one of the differences, which is that we know what caused this, and we actually, in a way, kind of chose this to prioritize saving people's lives. What are other ways that this experience and this recession is different than what we've experienced in the past?
So I think that is the main one, which is like some people say that we've actually put the economy into a medically induced coma is something that you hear, right? That we've decided on purpose for our own good to sort of, get the activity down. And we did come into this pandemic in a very, very good shape, right? Unemployment was really, really low. People felt very good about the economy. And so there's hope that if we can sort of get through the health aspects, that we could go back, right? And so a big, big question is that really feasible, that we would quickly go back to where we otherwise would have been? Like, what is that recovery gonna look like? But, the problem is that we don't even know what the sort of how long this medically induced coma is going to last, or if we're going to take us partly out of it, right? If we go back to work very slowly, and then maybe we'll look like, oh no, the virus is spreading again, and then we'll do it again. And so this is a time where the economists cannot operate without the epidemiologists, right? Like it's very, very contingent. So from an economic perspective, what we want to do is to do everything we can to make sure that when it is safe to go back out, that actually activity ramps up quickly. And that's not certain, right? And so that's really the big question, is whether or not we are going to sort of have so much damage done while, people are not going out and going to work, that even once it's safe to do it, people won't have the money, they'll be too scared. Like those are all the issues that we can talk about.
Great. And I'm sure there are going to be a lot of questions relevant to that. But before we go into those kinds of details, I want to talk about who are the decision makers here. So can you just give us a sense of the primary institutions that make decisions that affect our economy in general, but then also, now?
Sure. So think about who makes the spending and tax decisions. That's Congress, and the administration has to, agree with it. But it's basically laws are set by Congress, and so we've had 4 lead packages already to try to help with the economy. So Congress has passed an expansion of unemployment insurance. People must have gotten their rebate checks mostly, I hope, to try to help people get through this period. You've heard about these loans to businesses. So that's all Congress. So Congress writes those laws, but then they're carried out by the administration, right? So Congress writes this view of what that business lending program should be, but then the rules themselves will be written by this Small Business Administration and the Treasury, right? So the spending part is Congress. There's also been a lot of activity by the Federal Reserve, right? So what we think of as fiscal policy is spending and taxes, that's Congress, and then monetary policy is the Federal Reserve, which is a separate institution. And the Federal Reserve does sort of a lot of things, but in sort of 2 big things. One is they sort of set the interest rate on the economy. So right away, they like slash the interest rate to try to like make lending as cheap as possible to try to help people smooth, get through this period. But they're also a so-called lender of last resort. So a lot of times what happens when the economy goes bad, the whole financial plumbing, everybody gets really scared and they all want to get cash, and no one wants to lend to anybody because they're all worried they won't get paid back. And so then you can get this sort of freezing up of credit and no one can borrow. And so the Federal Reserve kind of steps in and is kind of what's called a lender of last resort. So they have set up many, many facilities kind of based on what they did during the Great Recession. They did a lot of that was very new in the Great Recession, but now they know how to do it. So they quickly kind of started doing all of that again. They've done even more than they did in the Great Recession now to try to really do everything they can to help the economy through this terrible period, right? And so they lend to businesses, to state and local governments now with the expectation that they'll get repaid. Mostly, right? So they don't expect to lose money. They expect to basically get most of it back. And this is just saying, right now, no one else is going to lend to you because everybody's too scared. We can do it. We're going to step in and do it.
So, okay, so the Federal Reserve, where does it get its money from and how much money does it have?
So the Federal Reserve is basically can create money. And so when you think about, they're just printing money, they don't print the actual money, but they basically have an effect on the money supply. So the Federal Reserve doesn't have a budget constraint in the same way that the Congress does, right? I mean, Congress doesn't have a budget constraint, but they have a deficit. The federal can really spend as much as they want because all they're doing, remember, they're only doing loans in some sense, right? So it's kind of like they're lending you money, but they will eventually get most of it back, if not all of it back.
I guess, how is it different than a bank?
Well, so it is the central bank, right? So a bank itself needs deposits, so they need people to put money in order to lend it out. The Federal Reserve can create money, basically, right? And so that's how they can set the interest rate in the economy. They can say, oh, look, the interest rate's too high. We need to sort of create more money, get the interest rate low. And they do that with this mandate from Congress, right? So they can't just do whatever they want. They have a mandate, and the mandate is price stability. So they care about inflation. If you just created money, and then you get a lot of inflation. So they care about inflation, but also maximum employment. So that's kind of what guides them. And so making sure that the financial system is working well is very important for maximum employment, because otherwise you're just going to have all these businesses go bankrupt and an incredible, unemployment way beyond what is necessary for the virus itself.
Can you talk a little bit about interest rates and why that's such an important part of the conversation here, and maybe also lending and borrowing and how that plays into all of this and healthy economy?
Yeah. So, and a healthy economy depends very much on credit, right? People have, they might have very good business, but they get all their business in August, right? For something, they have a resort that's open mostly in August, right? So they need to be able to smooth through. State and local governments get taxes, at certain times of the year. They need to be able to smooth through. So having credit means that people can actually operate without worrying exactly today, do I have enough money coming in and money coming out? So it is sort of a key. It's what they call it, the plumbing of the system. When interest rates are high, people are less willing to borrow and invest, and that will sort of bring the economy down. So when the Fed thinks the economy is overheating, they raise the interest rate. When the economy is in a slump, they lower the interest rate. Now, the interest rate is at basically zero right now, so they can't really do more on that front, right? And it's not even clear how much that helps right now, because people aren't going out and spending, and they're not going to, the interest rate would be low, but you're still not going to buy a car because you're staying home, right? So they're not doing that much on the monetary policy front. They're doing as much as they can, but they really need Congress to step in with actually sending people cash. The Federal Reserve cannot send people cash. It doesn't have that mandate.
They mainly work with companies and the setting the interest
Right.
rates, and then also doing
I mean, they
loans
mainly
and
work with banks, and then the banks
right.
work with the companies, right? Now, this time they do some direct lending to companies, but these are these unusual facilities of this lender of last resort. But most and regular things is they lend to banks, and then banks lend to people. And so they set the interest rate at which they lend to banks, and that kind of sort of filters throughout the economy and sort of sets all the interest rates. But they only set that direct interest rates to banks,
Got it. So it's kind of like
right?
banks are following suit. They don't have to
Right,
abide by those interest rates, but
right,
because they're borrowing from the
right,
Fed. Then,
right.
and when people say the Fed, is that what they're talking about? The Federal Reserve?
Yes, the Federal Reserve, which is the Federal Reserve System. So the Federal Reserve Board of Governors is in Washington, D.C., and it's headed by Jay Powell. And there are these 12 Federal Reserve banks throughout the country that sort of operate within their areas and do the check cashing and sort of functions, and also sort of report back to the Fed about what's going on in the various parts of the economy. And then on the interest rates, it's a committee that's going to be some Federal Reserve Bank presidents and the members of the Board of Governors. So it's a combination.
Okay. All right. So that sounds like that's one of the tools, right? Lowering the interest rate. What
Yeah.
other tools are available to the president, to the Fed, to Congress to stabilize a weak economy?
I mean, I think basically that's fiscal and monetary policy is the two, and we've talked about both. So monetary policy is the Fed and fiscal is Congress, and there's many, many tools, right? You can, do loan programs themselves. You can, uh, I mean, I guess apart from fiscal policy, there could be rules that say we're going to have a moratorium on rent payments, for example. That would be something that's not actual spending, but sort of just regulation.
Some states are
So,
doing that.
yeah, I don't actually know the legality of what the federal government can do on that versus the states, right? Because there's some rules that some things Congress can do and some things only the states can do. But basically, the way to think about it is fiscal policy. They've done $2.5 trillion already in fiscal relief and fiscal stimulus, a lot, which is appropriate for the kind of numbers that we've been talking about, for the decline in the economy that we've seen, right? With unemployment rate going up to 15%, probably. That's a lot of people who need help.
So a couple more questions and then we'll go to Q&A. So if you have questions you want to put in the chat, now is a great time to do it. You can send them right to Anna. So you were just talking about the $2.5 trillion. Two big questions here. One is, where is the money going? The second is, where is that money coming from?
Okay, so where it's going is to this sort of wide array of programs, these loans to businesses to allow them to keep operating and keep their workers on, right? So that's that paycheck protection program that we've heard a lot about that sort of ran out of money quickly, and then they put some more money into it, and we'll see how it was. It's hard to do things fast. It was completely new. It's in better unemployment insurance benefits, so they added $600 a week to unemployment insurance, and also expanded unemployment insurance to people who could never get it before, like an Uber driver whose business has now dried up because no one's asking for Ubers anymore. It's the $1,200 per taxpayer plus $500 per kid checks that have some have gone out and some are still going out. What else is there? It's help to states and local governments for fighting COVID and help to hospitals. So those kinds of things, enhance a little bit help through Medicaid, higher Medicaid spending by the federal government. So that's where it's going, right? So all these new programs that have been created to try to keep the economy in decent shape so that when it's safe to go out, we can kind of quickly get back to where we were. Where does the money come from? So it's borrowing, right? So if you look at the debt to GDP ratio. So the debt is the stock of everything we've already borrowed, like your mortgage. How much is your mortgage? Well, how much is our debt, right? How much do we owe? So that was about 80% of GDPs before the pandemic, which was already considered quite high, and is expected to go to 100% by the end of this year and 108% by the end of next year. So that sounds like a lot of borrowing, right? And it is a lot of borrowing.
Does that mean that we're kind of borrowing more than we're making? Or
yes. Our stock of debt is more than we're making it.
Yeah.
Right. So in some sense, that's how we kind of gauge it, but there's nothing special about 100% really. It just says, I mean, sometimes your mortgage might be more than you're making because you expect to pay it off slowly. And so think about it that way. It's this big amount that we owe. But what's quite interesting is that, if you had asked economists, 10 years ago, boy, if they increase the debt so much, what's going to happen to interest rates? We usually think that interest rates will go up, or they're going to be borrowing so much you're going to have to pay a lot of people a lot to lend. But actually what's been happening is interest rates have been falling and falling, and they're at incredible lows now. So interest rates are really, really low. And that's because people are saving a lot. There's been a lot of saving in the world, and people are also particularly happy to invest in treasuries when they get nervous because it's still viewed as the safest.
And what's treasuries?
So treasuries are how the federal government borrows. It basically says, who's going to lend me money? Fine, I'm going to give you this IOU. That's a treasury security in exchange for money. So you're a saver and you're like, I want to save in a really safe way possible. I don't want to be in the stock market. I'm going to go put my money in treasuries. It's an international global market. And so many people from other countries are like, oh, I want something safe. The US government's not going to default. So there's really a lot of desire to lend. So interest rates are really low. So that means you can have a high debt and it doesn't cost you that much, right? And nobody really knows how high the debt can go. It can't keep climbing forever. But, Japan has a debt to GDP ratio around 200% of GDP, and its interest rates are also quite low. So there's been a sort of a recognition that we actually can have a higher debt than we thought. And then if you think about it in this context for the pandemic, if you don't do the spending now, what you risk is a depression, right? And that means that economic activity is going to be really, really low for a really long time. And then you can't pay off your debt. Right. So the best way, in some sense, to ensure your future well-being is to make sure you get the economy back up to where it was. And so it's a good investment to sort of spend the money now. And it's only temporary. It's not like we're going to say, oh, we're going to raise the debt deficit this year and next year and forever. It's like, well, this is an emergency, like a war. We're going to raise the deficit and then hopefully get the returns, which is get back to the kind of growth rates that we had before.
All right, so we're going to turn to Q&A.
Okay.
Before we do that, you mentioned if this were to drop into a depression, we'd be seeing the results of this for a long time. When you say a long time, what do you mean?
Well, possibly sort of permanently, but I don't mean unemployment would stay really high forever. So what is happening now is that we're sort of losing a lot of GDP, right? So it declined. And then the question is, once things are better, do we pop back up to where we would have been before? Or do we never really quite get there, right? So if we have less investment for a long period of time, if people become very fearful and so don't want to spend, if there's not a lot of new innovation for a year, and so all those new ideas that could have happened and the new stores never happen, then in some sense we lose those forever. And so we could continue growing, we could have good GDP growth rates, but we don't get this really big boost in GDP as we're recovering. And so that's sort of almost like forever, that like just Emma, we have this loss in wealth and we don't make it up, and forevermore our output is less than it would be. I don't think anybody really thinks 50 years from now forever, but we're talking, for the next 10 years. If you look at the Great Recession, it kind of looks like that. We were on this path of GDP growth, GDP fell, and it never quite made it back up to where you thought it would have been in the absence of the Great Recession, right? People lose skills. They might leave the labor force. They might say, it's so hard to find a job, I'm just not going to go, and they never go back in, for example.
Okay, so on that note, I'm sure we have lots of questions. Anna, can I turn it over to you?
Sure, yeah. So one of the first questions we had at the top of the meeting is someone was asking, what's the difference between a repression rather than a recession? They've been reading some articles calling this a repression rather than a recession.
So I hadn't heard that term, but that's, I think, the equivalent of that, coma that I was talking about, which is that we are purposefully holding down economic activity, right? And so, and that's the sense in which it's different. It's not something that the economy was bad. If we think about the Great Recession, we said like the housing market was a bubble, and there were all these people who got loans that shouldn't have gotten loans, and people had made really bad bets, and that's what caused the recession. That's not the case here. This is repressing activity is a good idea and is a good term for it. And so the economic question is, does it turn into something that then has a life of its own and keeps activity down? But I think that's right, that what we're seeing right now in terms of GDP falling is not a bad thing. It's what we wanted. We wanted people to stay home, and not everybody can work from home. And so GDP is going to go down.
So Claudia asks, money notes were created based on actual silver and gold. What is our money based on?
The full faith and credit of the U.S. government, right? So it's not based on any actual, it was for a while on gold and silver and then the gold standard. And so it's just based on this fact that, the United States has a ability to repay, and money is basically an obligation of the United States government. And so it is something that we just use as a means of exchange, right? I want to sell to you, you want to sell to somebody else. We create money so that to make the system work better. And then we rely on this mandate that I said to make sure that we just don't print so much money that we just get a lot of inflation. And that's why inflation is part of the Fed's mandate, because they can create money to expand the money supply, but they have this congressional mandate that says you can't, just have really high inflation. And there is debate about what it means. The mandate actually says price stability. The Fed interprets that as 2% inflation. That's their target. That's what they think is kind of the congressional mandate. That's their goal. They might be low, they might be a little high sometimes, but that's kind of what they're aiming for.
Got it. All right, so we have a question from someone who's going to ask it live. So we have Kanishka. So I'm Kanishka. I'm going to unmute you right now, and you are live to ask your question.
Thank you. Good evening. How are you doing?
Good. How are you?
I'm well, thanks. So yeah, I'm. A few of my friends and I have been trying to sort of figure out this whole PPP and the sort of limitations that they have. The 100K, the 130K. There's talk of another sort of round of it coming out. I'm curious to hear your take on how that 100K really doesn't equate to the cost of living in places like Florida and Louisiana compared to like New York and Massachusetts, right? And I'm curious to understand what was the math that, was considered when they put these numbers in place.
Okay, so there's two issues. They put this program that lends to smallish businesses, basically pays for 2 months of payroll. If you don't lay people off, it's a loan, but it will be forgiven. So it's basically a grant to pay the payroll of small business, but for each, the only payroll that counts is payroll up to $100,000, right? So if you have employees who make $130,000, it will only pay for up to $100,000 for 2 months of their payroll. So that's the 100K you're talking about. And it's true that it's different in different places. So it's like not a lot in New York and it's a lot in Arkansas. That is kind of something that the federal government in general does. So if you think about the tax system, the tax rate that you pay depends on your income. When you make more money, you pay more taxes, but it doesn't account for the cost of living. So you could find that as a criticism in general of the federal tax. They don't like to do too much that's based on the cost of living because they really want to have equal treatment sort of across the country. I also think that this PPP was created very, very quickly, and it's completely new. And so they were, I think, rightfully trying to not take too long to try to be perfect. I mean, that was true of the unemployment insurance changes as well. They're like, this is not perfect, but it's quick and it's easy to understand, and we don't have to have complicated forms where we have to go look up and we have to decide what, how to decide what that limit is in every place. And it kind of got this theme that we're not going to pay huge salaries, but we'll pay most salaries. And so, there are a lot of problems with the PPP. I mean, you've seen these sort of big firms who took it, who didn't seem like they should have been eligible, and now they're being asked to pay back. So I think there are a lot of problems, but the idea was to just try to get money out quickly so that we wouldn't have this huge wave of bankruptcies. And of course, it's something that we're going to be looking at, in the months and years ahead to say, well, perhaps that wasn't the best way, or perhaps it was, or maybe, when this ends and we want to do it again, we will do it slightly differently. But I don't think we'll do something about the cost of living, because that's not typically something that Congress does. So does that answer your question?
We had remuted him.
Oh, great.
So
okay.
We hope it does. If not, you can ask another question.
I hope that answers your question.
All right, so we have a question from Carol. So she's wondering, why are big businesses getting some of this money? I think she's talking about stimulus money over some small businesses.
Right. So the part of what's happened is the way it was written. I think, I'm not an expert on PPP in terms of the law, but I think it was written about like in a particular place. So like all these places that had franchises, like Ruth Chris Steakhouse and, some of the fast food Shake Shack, were big corporations nationally, but each sort of restaurant was small. And so they sort of snuck in under the rules. And remember, the rules were written, like there weren't a lot of rules because they were trying to get that money out. And so the question is, who should get the money? And one of the things that I think Congress sort of maybe shouldn't have done is it said, we are spending up to like $350 billion on this, which meant there was a rush to try to get those loans because you knew that they weren't unlimited, right? And so what happened was that big businesses that already had a relationship with their bank were able to kind of get first in line. The bank said, I know you, I'll help you through this. If you were some mom and pop store, you never took a loan from a bank, your bank didn't know you didn't know how to operate the system because you're not used to it. You tended not to sort of get the loan. Now they've expanded it, but they may run out again. And then we'll see what they do. But I think it would have been better if they had just said, here's the rules about who's eligible, maybe been a little bit more careful sort of designing it, and then said, whatever it costs is what we'll spend. That is sort of what unemployment insurance is. They don't say we have X billion dollars to give out. They're like, here's the rules, here's the eligible. It's an extra $600 a week through the end of July, and whatever it costs, it costs.
All right, now Marshall has a question. He asks, consumer spending in manufacturing has not returned to pre-COVID levels in South Korea or China after social controls were relaxed. What are the implications of the same scenario here in the United States?
So, yeah, that's a very good question. So people talk about, the government shutting down the economy, and therefore the government can reopen the economy. And that's not exactly right, because it really depends on, one, how they do it. They may sort of reopen the economy, but with a lot of, which I think happened in Asia, like you have to be 6 feet apart in your office. You can't have people at the lunch table. So like it's reopening, but still with measures in place. So that's one. And the second thing is, if people are nervous, they are not going to go spend. Right. So, it may be that the restaurant is open, but I personally feel like, I'm not young and and there's no vaccine yet. I'm not going to restaurants. Right. Or I'm not buying tickets to sporting events, even if they're available. So, that's why people talk about, the best thing for the economy is to get the virus under control so people can feel safe. But I think until we have a vaccine, we're not going to be back to where we were, because there's just going to be, we're going to have to keep sort of paying attention, and there are people who have sort of, immunocompromised are not going to go and do what they used to do.
So Natalie asks, why are we continuing to see growth in the market even though we are in this repression?
So actually, I haven't checked the market today, but I mean, market fell a ton. It fell like 30% at the worst of it. And then as it looks like that maybe Congress is going to do something better, maybe we're going to get to a place that's not as bad, then you're going to see growth in the market, right? So the market is just the expectations of the stream of profits that these companies are having. The market is still down, but it's not as down as it was. So, and sometimes there's panic. Right. It was really at the beginning just hard to have any idea what anything was worth, because you just didn't know it's this new virus, and is it, are people going to be dying in the streets? What's happening? Like nobody knows. And so there's panic. And so then you see this huge sell-off. And so the market tumbles. And then maybe as people start to say, well, okay, it's bad, but maybe not quite as bad. And, after a few years, it should be fine. So then you sort of get back up to a more reasonable level. Because remember, the stock market is the value of owning a company, which means not just profits this year or next year, but for the foreseeable future. So even a really bad few years shouldn't have a huge effect. I mean, have big effect, but shouldn't have this enormous effect on the value of companies. And then if interest rates are lower, that kind of raises the value of companies too. So those are all the factors at play.
So we have another question from John. He asks, given the likely duration of this crisis and the need to stimulate the economy, would it make sense to lower income tax rates, particularly for low-income earners?
So the question is whether or not you want to use the tax system or you want to use direct spending. So a lot of low-income earners don't pay taxes. So it's harder to use the tax system. They do get this earned income tax credit. You could kind of try to increase it, but remember, that stuff only happens sort of like once a year, right? And also the earned income tax credit, actually, I'm going to take that back. It's not a useful thing because it depends on having earnings, right? So if you don't have earnings, you don't get a refund from the federal government now, and you don't pay taxes. So trying to lower your taxes doesn't help. What we really want to do is get money to people who otherwise would be unemployed. So that's the PPP. The whole idea is that you don't lay off your workers. They may be staying at home doing nothing, but you continue to pay them. So that's the way we're getting money to people. And then the unemployment insurance increases also. So the problem is that the tax system is kind of based on having earnings. And the other thing is it's not immediate, right? You might like say, I'll eventually owe less taxes, but you're not necessarily getting the money right now when you need it. And so trying to get money into people's pockets faster has kind of been the goal of this.
So if you are either just joining us or came in late, we just want to let you know that if you have questions, you can send it to me in the chat, and you can ask it live or I can ask it for you. So we're going to dip into some of our questions from our registration. So one of the questions we have is, what can citizens do in the near term to help our economy bounce back?
So I think that the most important thing people can do is to actually stay home, wear masks, stay safe, and make sure that we try to contain this virus as best as we can, because that is what is holding the economy down. So to the extent that you can contribute by not risking passing on the virus to somebody else or getting it yourself, that is the best thing that you can do for the economy right now.
Carol had another question before. She was wondering, if you were in charge of the recovery, what would you be doing to jumpstart the economy and help those at risk?
Okay, so I think the big missing piece of what's been done so far is that there has not been any general aid to state and local governments. So state and local governments have to balance their budgets every year. When tax revenues come in very weak, as they will this year because income is down and sales taxes are going to be way down, they don't have any money coming in. They have big demands on them from the virus, and they're going to have to start, they're already announcing this, they're going to start having to start laying off people, cutting programs. That is bad for the people who, who work there, and it's bad for kids who have big class sizes, and it's bad for the services are gone, but it's really bad for the recovery as well. So in the Great Recession, there was help to state and local governments, but they pulled it back too quickly. And one of the reasons the recovery was so slow was because state and local governments basically kept firing workers, and it took them like 10 years to get back up to where they had been. So that's piece number one. I would do that. And the other thing is that you're hearing people saying, oh, wow, the debt is so high. Can we afford to keep doing this? And I think the answer is yes. And I would just make sure that, I would put things like triggers on some of these programs. So like, let's keep the extra $600 per week, on until the unemployment rate comes back down to 5%, for example. What you want to do is not shut off the spigot too early. You want to keep providing support to the economy until it really has legs and is kind of clearly going to be strong and back to where it was. And that is a really good investment. And I'm worried that we won't do that because all of a sudden people are starting to worry about the debt and say, oh, we can't afford to do that. And my view is you can't afford not to.
So let's go to a little bit of a more international scale. So will other countries in the world also be going through economic recessions?
Yes. So this is a kind of global phenomenon. Every country is seeing the shutdowns because of the pandemic. And most countries are also doing these big fiscal stimulus packages. So I think that the experience in the US is quite similar. I am not at all an expert on sort of countries that may not be able to afford to do the kinds of things that we're doing. I mean, the United States can borrow, as I said, sort of as much as it wants. We borrow in our own currency. People are willing to lend to us. That's not going to be true of sort of smaller countries. They might have to borrow in dollars. It might be really hard to repay. So I think this is as bad as for the US, can be much worse in other countries. But the basic economics are sort of the same, which is like if people are not spending and they're not working, then you're going to have a recession and you're going to have problems.
All right, so we have a question from Sergey. He asks, let me just get to that real quick. He says, what do you see as the worst case scenario in terms of the COVID-19 impacts for the US economy? What's the best case?
Okay, so the best case scenario is one where, the best case scenario is like we miraculously find a cure, before we have a vaccine, and so then people aren't as scared of it. We know, oh, you can get sick with it, but we know how to deal with it. Or just that it becomes less scary, or a vaccine, obviously, right? So getting rid of the underlying cause is the best case scenario. Barring that, I think, as I keep on saying, we want to keep supporting the economy and keep making sure that people are, their credit ratings don't get bad, that they don't kind of get rid of all their savings, that they're not evicted, that they can afford food. Like, we want to support the economy until that time when the risk from the virus is gone. And then we can sort of start removing that support. The worst case is part of the worst case is, we don't get a vaccine. And we don't learn how to treat it very well, and it just proves to be just really tricky. And so this lasts a really long time. It's hard to imagine what that looks like, right? It's hard to imagine doing this kind of thing for, years. But assuming that's not what happens, and that's not an economic issue, that's a sort of science issue on medicine. I think having people have really impaired balance sheets, having waves and waves of bankruptcies, having state and local governments cut spending will really set up the stage where it's possible we could have, a decade of terrible growth.
So we have a question from Michael, and Michael, I'm going to unmute you, and then you can ask your question live. So here's Michael.
Hey, everybody. Thanks for doing this.
Hi.
My question is, so our government just has put out billions of dollars. What are the long and short-term effects of that?
So, as I said before, people used to worry that higher debt was going to lead to higher interest rates. And, it's possible that there'll be some increase in interest rates eventually when the economy is booming again and it has this big debt. But what we've noticed over the past sort of 20 years that is interest rates have been coming down. People argue about why that is. Part of it is related to an aging populations have more savings. People have been worried. I don't know if you've heard the term before this whole pandemic started. People were worried about so-called secular stagnation, that we just couldn't get really a highly productive economy, and sort of argued for having a bigger federal role. So having a higher debt especially from the pandemic itself, I think is not a huge issue. If we go from 80% of GDP to even 120% of GDP in terms of our debt, but then don't just keep on adding to it year after year, that just means we have to pay a little bit more in interest, for the foreseeable future, but it's not a huge problem. The big problems that we have sort of in the long run is the aging population, and we have these projected deficits that just rise year after year after year. Eventually, we're going to have to do something about that, something about adjusting our tax and spending system to an older population. But I think in the near term, we're not particularly worried about it. And in fact, one of the things that we think is going to happen because of this pandemic is actually lower interest rates. People are going to be not worried about spending. They're going to want to save more. That's going to be true all over the world. And they're going to have to put their savings someplace. And so they'll be sort of happy to park it with the federal government. And so we won't have to pay very much for that. But of course, it's always a risk, right? I mean, we have these projections of what interest rates are going to be. We think they're going to stay low. Long-term interest rates, 30-year interest rates are incredibly low. But it could be at some point people say, wait a minute, your debt's so high, we don't want to lend to you anymore. And you could have some kind of, debt crisis, but I think that's relatively low probability. And also the alternative right now in terms of like letting the economy kind of really sink and not have a way of getting it out is clearly much worse for the future. And the reason we worry about the debt is because we're like trying to preserve the growth rates for the future and make sure that we're not sort of banking our grandchildren. And so what we want to do is leave them a good economy in good shape more than sort of a bad economy with less debt.
A follow-up question to that. So is the ownership of national debt different now? We're borrowing all of this additional money people are loaning us. And by us, I mean, I guess the federal government, right? So, I mean, I've heard a little bit about how China owns a lot of our debt. So I don't like how's that all playing out?
Yeah, so China does own a large part of our debt. I don't remember the numbers right now, and I can't remember if it's sort of changed. It's not something we worry too much about because we kind of think about a global capital market. Their money's flowing, here, there, and everywhere. It was a worry way back. Oh, well, China's not going to, they have control over us, but we have control over them too because, like, if
we buy a lot of their stuff.
Well, we buy a lot of their stuff, and also like if we're not going to default on our debt, but if they worry that we default their debt, well, they would be the ones sort of holding the bag. So they're not going to want to sort of start something, as it was not in their self-interest to say, oh, we're not going to stop lending. We're going to kind of try to punish you by not lending to you because that would punish themselves. So, there's just massive amounts of capital in the world and it's kind of going to the best place. And that sort of changes all the time. But I don't have the numbers, in the back of my head about sort of who's holding our debt right now. Probably should, but I don't.
There's a question related to that. So this is questions from Gabriel. And this event was almost about debt. But his question is, if as a country we are already in so much debt, how are we able to continue to borrow?
Well, see, that's kind of the point, which is that it seems like it's a lot of debt, but nobody really knows what a lot of debt is, right? So we just sort of based on history, it looks like a lot of debt, but it's not so much debt that people aren't willing to lend to us, right? And it's not so much debt that if you do sort of projections of like how much are you going to be spending on interest, like in 10 years and 20 years, it's not sort of crazy numbers. Like we can afford that. The U.S. has huge taxing capacity also. So if necessary, you could always just raise taxes somewhat. We have this huge economy, right? So if you think about an interest rate, I mean, the interest rates are like less than 1% now, right? And if that were to persist, then you're paying less than 1% on a growing economy. It's quite easy to finance, right? It's saying, like, imagine you had a mortgage that was, equal to your income, but your income was growing quickly and your mortgage interest rate was 1%. It's just not that huge of a deal. And so, and the fact that we have this big debt and people aren't worried about it, so they're not saying, oh, we're not going to lend you because you're not going to pay us back. They fully expect it to be paid back. And I think that makes it sort of just, we can afford it.
All right, so we have another question. It's from Melody. She asks, could you talk a bit about the rationale behind bailouts like that of the airline industry?
So I don't know the specifics of the airline bailouts. So a bailout is basically saying, look, this company would go bankrupt, but for us. And so that would be bad for the economy. So we're going to go help out the industry. We're going to give it some money. I think that the airlines were grants. I don't actually remember the details. A lot of times what we'll do, like what the Fed does usually is lend. So it lends, and sometimes it will say, I'm going to lend, and if you do really well, we're gonna take a piece of that. So actually, in the Great Recession, all of the loans the Fed made that were called Wall Street bailouts, on average, the Fed actually made money from that, right? Because it took these positions in these companies, and the companies did really well, and so they got back sort of more than they put in, plus more than even just interest. So
how is that the case? How would they make back more than
so
what they put
imagine
in?
you say, look, I'm gonna basically take some of the upside risk. So I'm gonna give you money, but if you make more than, I don't know what the actual contract looked like, but it basically says if you make more than 10% profit, we're gonna get some of that. It was those kinds of warrants that they would call it. I'm not an expert in the details of the loans, but you can set those things up. I don't think that happened with the airline, and I haven't really thought carefully about whether or not that one was particularly warranted. But the idea now is to say, look, we don't want things going bankrupt. And the other issue that I think is different between the Great Recession and now is one of the objections in the recession was people made bad decisions, and then when the bill came due, the federal government came in and helped them out, right? So they bought houses they shouldn't have bought, and they gave loans to people who could never repay them, and they did all these fancy derivatives, and then they got into trouble, and the federal government came in and helped them out. That's not the case here, right? This is really coming from this, once in a hopefully 100-year kind of a health risk, where we're sort of telling people don't fly. So you can sort of say, look, if the government is telling people don't fly, then maybe it's not crazy to say, well, we'll help you out, airlines, since we're sort of telling people not to fly. But you could say, well, the shareholders maybe should have taken some of that risk because they make money on the upside, and so this is some downside. But that I don't have a strong opinion on that.
So we're coming close to 6:30. So if you have any last-minute questions, send that to me. But what can we learn from history? Great Recession, the Depression. What are some things we can pull from history?
So I think that what we learn from history is sort of two things that I've sort of mentioned already, which was, the Fed learned to immediately go in and try to make sure the financial system keeps functioning. Because if you let the financial system start to crumble, then you get all these other effects that were not necessary, right? Sort of fire sale stocks, things just kind of can go very bad very quickly. So they used what they had learned. They had these things off the shelf that they had closed down, these lending facilities, and they're like, okay, we're going to reopen them right away. So that was good. And I think the other thing we learned is that, I hope we learned, and this is what we're going to find out, is that you need to support the economy as it gets out of a recession if you want to get back to the kind of strong economy that we had before. And one of the sort of tragic aspects of this is that before this started, the unemployment rate was 3.5%. And it wasn't just the unemployment rate was low, but all these people who had left the labor force, who had hard times getting jobs, were coming back in. People who had prison records were starting to get hired. People who were disabled were finding jobs. People who had just not worked for 10 years were finding jobs. It was really good. It's like, let's see what happens if we have a really strong economy. Maybe more people can work and can find jobs. And now, that's all been destroyed. And, my hope is that we don't settle for less, that we say, remember that was really wonderful. And it was very inclusive, and we were getting to see how well the economy can do. Let's keep supporting the economy till we get back there.
Well, thank you so much. We're nearing on 6:30. So we are going to, I'm going to make some closing remarks, but actually Louise has said that she's available to stay a little bit longer. So after I give these closing remarks, if you have to go, completely understand, but I'm going to ask her some questions that more have to do with how values factor into some of the decision-making about what to do about a recession. So I'm just going to share my screen briefly. Okay. Thank you for everyone for joining us, whether you were listening in over your phone or you were watching on YouTube or you were here with us live on the digital Zoom event. We really would appreciate it if you would take 1 minute to fill out our survey. You can find it at civicseries.org/survey. And Anna is putting it in the chat there, so you just can copy and paste and put it in. We read every single survey. We'd love hearing from you. It'll take you 1 minute. We're also really excited that we have our next event planned for Wednesday, May 20th. On the influence of oil, we'll be talking about the different power dynamics internationally regarding oil. You might have heard about how the price per barrel of oil went negative last month, and also there was a trade war, price war between Russia and Saudi Arabia. So we'll dig into all that and how it affects the U.S. And the international market. And we actually, our expert will be Dr. Sergey Peltsev from MIT, who's actually on this call. So thank you so much for joining us for that. And if you need to head out now, completely understand. We will be publishing the recording of this at a later date. And if you're on our mailing list, you will get access to that. Okay, so that all being said, I'm just going to keep on going. The question, Anna and Dave and I were really talking about this in leading up to this event, and we weren't quite sure exactly how to phrase this question. But basically, the question is, how do political values factor into the decision making about how to handle the recession? Just to give a quick example, we know that Democrats, I work in the environmental space, so I know that Democrats were trying to get airlines to commit to, or they actually had already committed to, but basically to recommit to reducing their carbon emissions by a certain date. That didn't pass. So can you give us an example of how those kind of political dynamics play into this situation?
Yeah, definitely. So when you're trying to decide on how to support the economy, as we said, there's so many different things that one could do, and it does give you leverage in this example of the environmental stuff. And so I think, the Republicans tend to like a smaller government. They tend to worry about people being dependent. So their inclination would be more to support the economy through tax cuts, right? And then Democrats are more like, well, we like redistribution. We want to make sure that even people who don't work do better. And so they're going to be more supportive of increased unemployment insurance spending, for example. I mean, the debate over whether or not there should be aid to the states is political also, as well as values. So, the values is like, well, states should be really careful and have huge rainy day funds, and we shouldn't bail them out now that there's a bad event. That could be one view. You don't really want big government, and the state that sort of was worst hit is New York, which is a Democratic state and a big state with big pensions. And so they're worried about well, if we just bail you out, then you're just going to keep having big government and paying your teachers a lot and having big pensions, and we don't want to do that. And so as you're trying to decide, well, you could have two people who both want to support the economy. Exactly how they want to do it would be quite different. It would be depending on what they worry about and what kind of sort of, their values, I think.
Okay, great. I think that was a really great recap of what's going on here. What are some of the other examples of things on the floor that were being debated about what should be factored in and what shouldn't?
So I think that there were aspects where the Democrats wanted these triggers where spending would automatically keep going, these new programs, until the unemployment rate fell. They wanted bigger increases in Medicaid, and they wanted, I think a big area of debate was about health insurance. So what we're seeing now is that people who lose their jobs, if you've had employer-sponsored health insurance, you lose your health insurance. Now, under the Affordable Care Act, you are allowed, if you had health insurance and you lose your job, to go onto the exchange and get health insurance, but nobody does that. They don't know about it. It's complicated. They have 30 days. So what the Democrats wanted was to say, we're going to have a special period of open enrollment. Anybody who, even if you're supposed to have done it in December, but if you don't have health insurance, there's a virus out there. Come on, we're going to help you get health insurance. That was something that absolutely would not pass the Senate. And sort of, that just focuses on this whole debate about the ACA. Similarly with the Medicaid expansions, right? So if you, in states where they expanded Medicaid, they expanded to sort of adults with low income. If you lose your job and lose your income, you can get Medicaid. In other states, it doesn't matter how low your income is. If you're a working age adult without kids, you just can't get Medicaid. And so you're out of luck. So I think the healthcare is really one where that just was a huge issue, and there was very little done really on sort of trying to make sure that people have health insurance.
Yeah, and there was the recent Supreme Court ruling that just happened around ACA as well. And I think also I think the Affordable Care Act itself is going to go to the Supreme Court soon.
Exactly, right. So that's sort of what's happening is like the Republicans are still arguing before the Supreme Court, hoping that they will strike down the whole ACA. So you can sort of see why they're not going to say, well, yes, have a special enrollment period for the ACA, which we don't want to exist. And I think that one of the really interesting things that will happen that might happen is to see how the politics might shift on some of those things when we see how valuable it was to have a place to get health insurance that wasn't just your employer, and whether or not people will start thinking about it differently. But we'll see. Another interesting issue, I think, thinking about in that same vein is, Bernie Sanders was talking about Medicare for all, right? There was this whole thing about Medicare for all, and most of those plans involved very big cuts to how much hospitals and doctors would be paid. And I wonder whether or not that's still going to be the case, that people want that after this, when you're saying like, who are these people on the front lines, and the mortality is really high. So I think there will be not just long-standing economic repercussions of this pandemic, but political ones too that are really hard to predict.
Right. I mean, people's values are shifting.
Exactly.
They
realize, I could need government maybe, right?
So we have another question that's a little bit of a different topic. You mentioned before about how, because of the economic activity going down, revenue from sales tax is going to go down, revenue from income tax is going down. That could really impact on the local level, cities and towns.
Exactly.
Can you speak a little bit about
Right. So when I talk about states, I really mean state and local governments. And a lot of times the way you help state and local governments is you help the states, and you hope that sort of filters down to the localities. It's a little hard for the federal government to be like helping individual localities. There's thousands and thousands of different localities, but it does filter down. It's firefighters and teachers and police that, after the Great Recession, they just slashed hiring, and employment fell, right? And it took really 10 years. If you go look at state and local employment, it was only recently that it hit even just the level of 10 years ago, even though the population is bigger. And so they are having huge problems. They're also having problems because some of this, it may be that they'll get some, revenue sort of in 3 months, 4 months, 5 months. But in the meantime, they have like just decimated sales taxes. Like, they get these high restaurant and hotel taxes. Well, they're getting zero from that, right? Concerts in the summer, they're just losing a ton of revenue. And so one of the things the Federal Reserve did was to create this lending facility for counties, pretty big cities, counties, and states, not small localities. But and the idea being that some revenue they'll get, and they just need to smooth through it. But some of it's never coming back. We're going to just have lower revenue, and if we don't want them to slash services.
Louise, you are breaking up a little bit. Okay, I think hopefully she'll come back. Well, at least it happened at the end of the event and not early on. Maybe somebody started watching Netflix. All right, so all right, we'll see if she comes back on. If you have any additional questions, the far majority of you are still here, so that might mean that you have other questions. Hi, Louise. So you're muted, but I will unmute you.
It crashed.
I was joking
that
maybe someone in your house started watching Netflix.
That might be right.
So feel free to finish your statement.
I was just saying they need help. Like, otherwise we're going to have, they're going to be in bad shape. And especially ones that rely particularly on things like tourism, they're not going to see that come back for a long time. Right. And the people who live in those cities and rely on those dollars are just going to be hurting. And so I'm hoping the federal government will eventually do a much bigger help package for them. But it has become quite political. So we'll have to see what happens. Okay,
so another question, and then we have a question from a guest as well. are people actually borrowing, or not people, are companies actually borrowing right now? Obviously, they are not getting the revenue, but they also don't know when the economy is going to pick back up again. And perhaps they could be nervous that they won't actually be able to repay those loans.
Right. And so this Paycheck Protection Program was loans, but if you don't lay your workers off, they're forgiven. So they're grants for exactly that reason. If you're a small business, the last thing you want to do is take a loan now when you have no idea if you're going to be able to repay it. And most likely you're not going to be able to, because you're not going to make up those meals, the restaurant meals, or the loss, that you might make some of it up, but probably not most. The big companies, I think, they're ongoing companies. They're having this revenues that are lower now, but they sort of have the capacity to smooth through that. I don't know if they're borrowing, but I presume they are. That's not my area of specialty. But I mean, the idea was to give money to the smaller companies and lend money to the bigger companies who have shareholders. So maybe they'll, lose some value, the shareholders, but it doesn't mean the company's going to go out of business, because it still is clearly an ongoing, going to be a viable ongoing concern.
So we have a question from a guest. This is from Wendy. So this is talking or addressing kind of the long-term effects of the pandemic. So she asks, is the pandemic teaching us that we can manage with less, such as buying less, driving less, etc.? And so could that be a positive and sustainable development in the long run?
I mean, I certainly think that's possible. I mean, one of the areas that I think we have learned is that you don't need to fly to a conference, that you can do this kind of thing. And that sometimes, like we've noticed in the conferences we've held, you get better participation, right? People who just are happy to come in for an hour or two, but not fly to, and do a whole trip. So I think on the Zoom stuff, yes. On the restaurants and cooking at home, I think I think it's too soon to see, but we are changing our lifestyles. And if it lasts for a long time, then it may well be that becomes, have some lasting power. I think if it's short term, probably not, but if it's long term, it might have lasting power. And, similarly with online learning, I think people are deciding that maybe it's not as good, but also that we don't know how to do it yet. But so there are a lot of things that we're doing. The other thing is that people might, just they said, like, people who went through the Depression always were very thrifty because they were always kind of nervous remembering that experience. And so that's kind of another potential long-lasting effect, is that people just are going to increase their saving because they know something like this can happen. They'll probably increase the amount of toilet paper they have in their house.
So as a follow-up question to that, would people who are concerned about the state of the economy then see that as a negative thing, because they want people to be buying more and building more and going out more?
I think so. I think that's one of the worries, is that we will have an economy where not only people don't want to consume, but businesses don't want to invest. And so that sort of secular stagnation that I was talking about was coming from, like, an aging economy. You just don't have that much spending. And maybe it's going to just get worse. So I think people are worried about that. If people come out of this very fearful, then we probably won't grow as fast and have as much as we, had. So that's the role for the federal government then. So that way the federal government can kind of say, look, we really need more consumption, so we'll do it, right? So people are saving, the federal government spends it, and sort of like that finances the borrowing, is all the saving that people are doing.
And if they're choosing to not spend because they're being thrifty as opposed to being fearful, right? Maybe they're excited about cooking from home or some other things. I could also imagine a world where there's just more innovation to support and still sell things to people who are trying to do stuff themselves.
Exactly. So I think that you hit the nail on the head, that those are really very different. It could be that we change the kinds of things that we buy, but if we still want to buy stuff and we have extra money, people tend to figure out something to buy, right? So maybe it won't be restaurant meals, but we're going to go in for these crazy experiences, where we fly to the moon or whatever. So I think there's one is sort of how much we save and how much we spend, and then the other is what do we spend on, and those are separate.
All right, well, that's a positive note to end on.
Yeah.
So I think we will end there. Again, thank you everybody for joining us. And if you haven't filled out the survey at civicseries.org/survey, please do. Louise, thank you so much. This was a really wonderful conversation. Really appreciate your time.
Great. I really enjoyed it. Thanks for having me.
All right. Good night, everybody.
Bye-bye. Stay safe.